We in the United States feel no need to be self-conscious in discussing the dollar. It is not only our national currency, it is an international currency. It plays a key role in the day-to-day functioning of the free world's financial framework. It is the most effective substitute for gold in the international payment system. If the dollar did not exist as a reserve currency, it would have to be invented. For a volume of foreign trade, and growing rapidly, accompanied by large international capital movements, cannot rest solely on a slowly growing stock of gold. They are problems which cannot be met by one nation in isolation or by many nations in disarray. They are not the sole concern of either the rich or the poor, of either deficit or surplus nations alone. When burdens are shared, there is no undue burden on any nation. When risk is shared, there is less risk for all. And cooperative efforts to defend the international currency system based primarily on the dollar and to share other responsibilities are not therefore based on appeals to gratitude or even friendship, but on the hard and factual grounds of self-interest and common sense. Of course, the United States could bring its international payments into balance overnight if that were the only goal we sought. We could withdraw our forces, reduce our aid, tie it wholly to purchases in this country, raise high tariff barriers, and restrict the foreign investment or other uses of American dollars. Such a policy, it is true, would give rise to a new era of dollar shortages, free world insecurity, and American isolation, but we would have solved the balance of payments. But the basic strength of the dollar makes such actions as unnecessary as they are unwise. They would not only be inconsistent with the responsibility and role of the United States in the world today, they would, because of the crucial role of the dollar, be utterly self-defeating. All of us here are determined to follow the only other feasible course, not the unacceptable courses of restriction and isolation or deflation, but the course of true cooperation, of liberal payments and trade, of sharing the cost of our NATO and Pacific defenses, of sharing the cost of the free world's development aid, and of working together on steps to greater international stability with other currencies in addition to the dollar, bearing an increasing share of its central responsibilities.
The Triffin dilemma is a fascinating paradox in international finance that arises when a national currency, such as the US dollar, also serves as the global reserve currency. First identified by economist Robert Triffin in the 1960s, the dilemma highlights a fundamental conflict between domestic economic policy and the global demand for liquidity. At its core, the issue is that the country issuing the reserve currency must supply a steady stream of its currency to satisfy the needs of international trade and finance. To do this, it often runs persistent trade deficits, importing more than it exports, which floods the global market with its currency. While this process ensures that other countries have the reserves needed to facilitate international transactions, it also means that the reserve currency is backed by a growing amount of liabilities rather than tangible asset. Over time, this can undermine confidence in the currency's value. Historically, this tension was a key factor in the collapse of the Bretton Woods system. Under that regime, the US dollar was pegged to gold, and other currencies were pegged to the dollar. As the United States expanded its money supply to meet the world's demand, doubts emerged about whether the dollar was sufficiently backed by gold. These concerns eventually led to the suspension of gold convertibility in 1971, marking a pivotal moment in modern monetary history. The dilemma remains relevant today. Even without the gold standard, the US dollar continues to be the primary vehicle for international trade and finance. Critics argue that the inherent conflict between maintaining domestic economic stability and providing enough currency to support global growth, can lead to recurring imbalances. Some economists propose diversifying global reserves or even creating a supranational reserve asset, such as a basket of currencies or enhanced special drawing rights through the International Monetary Fund. These proposals aim to reduce reliance on a single national currency, thereby mitigating the risks associated with the Triffin dilemma. Understanding the Triffin dilemma is crucial for anyone interested in global economics. It not only explains historical shifts in monetary policy, but also sheds light on ongoing debates about the future of the international monetary system and the search for sustainable economic stability.
Hello, everybody. So glad to have you back. We are with our special guests, Smoke and Jesse over at Apex Crypto Consulting NFA. In this second day of our ongoing series, we're going to discuss in this segment, what is an SDR and why is the blockchain the solution for the eSDR? Now, a lot of you guys are new to this, so just a little disclaimer. SDR stands for special drawing rights, and of course, E would be the electronic version of those special drawing rights. We're going to get into all of it, so please consider smashing that like. I think we're going to earn it on this particular one, and please give these two a follow over on their platforms. Bottom left of the screen is their channels. For Smoke, though, you can be followed over at SMQKE DQG over on X. Smoke, what do you have for us? Take it away, sir.
What is an SDR? The SDR is an international reserve asset created by the IMF in 1969. SDRs are allocated to member countries in proportion to their IMF quotas, also called paper gold, as it is not backed by any currency or precious metal. Used only among governments of member countries in IMF for balance of payment settlements. Definition: the SDR is neither a currency nor a claim on the IMF. Rather, it is a potential claim on the freely usable currencies of IMF members. Holders of SDRs can obtain these currencies in exchange for the SDRs in two ways: through the arrangement of voluntary exchange between members, or by the IMF designating members with strong external positions to purchase SDRs from members with weak external positions. Why was the SDR created? To solve the Triffin dilemma. The Triffin dilemma is defined as the US dollar was the world's principal foreign exchange reserve asset. It still is currently. And a deficit is necessary for the United States to supply the world demand for its dollars. A deficit will in time lessen the value of the dollar and endanger the entire system. So over time, just by the inherent nature of the dollar being the world's reserve currency, a deficit is needed to keep that as a reserve currency. So to supply the demand for dollars, the SDR was ultimately created as a solution to reinforce the dollar as the world's reserve currency and keep that status despite efforts of de-dollarization or competition from other currencies. There's several reasons why the SDR is currently not succeeding in meeting its goals set out by the IMF, and here's some of the disadvantages of the current state of the SDR listed out here. The SDR provided by the IMF to its members is based on their subscription quota. The shares of developed countries are higher. The major portions of SDRs is available to them, which is unfair. So developed countries, non-third world countries, these are countries that have higher access to SDRs, even though they don't need them as much as third world countries or more developing countries. The share of SDR and its benefits, for less developed countries is comparatively lower. IMF restricts the borrowing capacity of less developed countries, which is unfair for less developed countries that don't have access to excessive liquidity and excessive capital resources to compete with the demands to earn SDRs from the IMF to bail them out of their personal country-specific financial struggles. The last point says this scheme was intended to save only the dollar prices. Subsequently, the linkage of SDR value with a basket of world's major currencies was again intended to safeguard the US dollar. The SDR, as we just mentioned here, was created to solve the Triffin dilemma, which doesn't apply to every currency. It only applies to the US dollar. So the fact that the SDR was only meant to help the US dollar and not all currencies is a reason why the United States has an unfair advantage with SDR compared to other countries. Moving on, here it says the IMF itself calls the current role of the SDR insignificant. Developed countries who hold the greatest number of SDRs are unlikely to use them for any purpose. The next highlighted portion says this is due in part to the fact that private parties do not hold SDRs. They are only used and held by IMF member countries, the IMF itself, and a select few organizations licensed to do so by the IMF. So this is basically outlining the fact that there is a popularity contest, a favoritism of sorts regarding help from the IMF and international efforts to help countries, because the IMF is not helping countries that are the most in need. They're helping countries that have the least amount of need, the most developed countries. Meanwhile, countries that are in the most in need aren't receiving the help from the IMF that they need at the time. Another reason they may see little use referring to the SDRs is that the number of SDRs in existence is relatively few. As of January 2011, SDRs represented less than 4% of global foreign exchange reserve assets. To function well, a foreign exchange reserve asset must have sufficient liquidity, but SDRs, due to their small number, may be perceived as an illiquid asset. So SDRs inherently aren't even liquid enough to be considered a reserve asset to even meet the global liquidity needs of the financial system. Moving on here, this is an illustration of the unfair allocations of the current state of SDRs. As you can see here, the highlighted portion says, as a result, those countries that do not need SDRs for balance of payments purposes receive a lot, while those countries that often need SDRs receive very little. The 2021 allocation was no exception. The G7 countries were, for instance, allocated in 2021 almost 9 times what Africa as a whole received. So as you can see here, countries with a smaller population with more resources than Africa receive more SDRs and more assistance from the IMF than a country in need like Africa. So this is just a reason why there's currently not a level playing field. There's currently not a fair, even access to liquidity and even credit and loan repayment ability because of the unfair distribution of SDR. So even from 2011 to 2021, this SDR issue has been prevalent in the global financial system, which is why the global community is calling for revamping of the SDR into an eSDR, a blockchain-based SDR, which will allow the SDR to actually meet the intentions of its original design. As you can see here, it says the world needs more special drawing rights now. The world is facing multiple crises. And here's several reasons why the world needs more SDRs. The global economy is in trouble, soaring poverty and hunger, a looming debt crisis, and even a global climate catastrophe. These are just a few of the international reasons why more SDRs need to be produced. However, the current form does not allow the SDR to be replicated in the same way that the blockchain allows. Moving on to here, this says, to become the world central bank, the IMF will need to extend the same treatment to both developed countries and developing countries. So no longer having favoritism, no longer showing unfair distribution of the SDRs, and actually developing a level playing field financially for all countries to have access to global liquidity. The next highlighted portion says, in addition, a super sovereign world currency would avoid the internal risk of sovereign currency and regulate global liquidity while maintaining currency stability. As a result, the functioning of the SDR as a price currency and means of settlement needs to be reformed and strengthened, establishing SDR issuing rules and improving SDR distribution methods. With the rise of the internet and using blockchain technology, it has become possible to develop a decentralized, highly secure, and creditworthy international digital monetary system. This will allow eSDRs to be issued and a new set of transnational payment settlement mechanisms to be constructed for the super sovereign currency. So this is explaining how, with the rise of the internet, with the rise of blockchain technology, we can finally upgrade the SDR and to meet modern digital needs and actually distribute the SDR in a fair and even way. Over here, it says, the decentralized authentication mechanism of blockchain technology can guarantee that eSDRs will be impossible to forge, and the eSDR will lend itself to direct use for payment, financial transactions, and so on. The parties will be able to trade directly in a peer-to-peer financial network with no third party involved. As a super sovereign digital currency, the eSDR could gradually develop into a currency with a stable value, an orderly supply, and an adjustable aggregate, thus maintaining global financial stability and promoting world economic development. So this is explaining why blockchain is a solution to upgrade the SDR into an eSDR and it even explains specifically that the decentralized authentication mechanism of blockchain is what guarantees that eSDRs will be a secure payment mechanism that can be used in private and public transactions to balance liquidity globally. The last highlighted portion says, as a globalized and borderless network platform, the internet provides the foundation for the development of an efficient and low-cost global payment and settlement system. So it explains why the eSDR should no longer be a form of paper gold or some sort of reserve asset that's not tokenized or not on the internet, that the internet actually facilitates and actually encourages the use of a digital reserve asset that should be used to facilitate and improve some of the shortcomings of the financial system. Moving on, here it says, the initial motivation for the issuance of crypto SDRs was to fill the gap caused by insufficient gold or freely convertible currencies as international reserves and to maintain stability in the foreign exchange market. The inherent problems and shortcomings of the current international monetary system, which uses sovereign currencies as international currencies, including the Triffin dilemma, which we covered earlier, have not been resolved. And SDRs have not truly played their expected role in stabilizing the foreign exchange market and supplementing the shortage of international reserve currencies. Since the birth of Bitcoin in 2009, the traditional information internet has been upgraded to a value internet of credit transmission, and blockchain technology has facilitated innovation and upgrading the traditional financial industry. Blockchain plus finance has been upgraded from financial internet to internet finance, ultimately achieving the global application of technology finance. And it says in this book covers combining the super sovereign legal attributes possessed by SDR with the credit of international organizations and blockchain technology to create a new super sovereign currency, crypto SDRs. So this is another concise explanation of why blockchain technology is the mechanism to improve the currency of the SDRs into crypto SDRs or eSDRs, which will allow a modern financial system to have a native digital asset, a reserve asset that all countries can have access to in a fair and even manner. Now, if you look at the last highlighted portion, it even says, at the same time, after the birth of crypto SDRs, they will also be of great help to various industries at the micro level, especially in the fields of payment, banking businesses, credit systems, equity certification, insurance businesses, etc. It goes to this is a confirmation that eSDRs, crypto eSDRs, the new form of SDRs, will be used. They will have to be used in private transactions for their use case to even be fulfilled and recognized. Moving on, any ambitious reform of the SDR should also embrace the private use of this global currency. This could include SDRs to denominate private or government bonds or as a unit of account in commercial transactions, for example, in commodity pricing. A virtual SDR could facilitate the SDR's use in private transactions, creating a global cryptocurrency that could circulate with national or regional cryptocurrencies backed by central banks. More confirmation that the new SDR, the virtual SDR, will be used in private transactions, and they have to be used in private transactions for the use case of the SDR to be democratized in the way that it was originally planned to. Well, that was the original outset, but the true goal was just to protect the United States dollar, which is not a goal that benefits all countries. So the new eSDR will have, I would say, international consideration for other countries and their currencies, and as well as the instability that may exist in those countries, not just the United States. Moving on, it says a virtual SDR could facilitate the SDR's use in private transactions, creating a global cryptocurrency that can circulate along with the cryptocurrencies backed by central banks. This is just further confirming the statements in the previous documentation. Here, this is a further explanation on how blockchain can make the eSDR reality. It says it may be possible for a blockchain settlement solution to incorporate a payment based upon some e-currency, perhaps an eSDR, since SDR is already familiar with operators today. Operators would need to obtain the chosen e-currency and then could have payments recorded on the blockchain. In this scenario, operators may only need to exchange to and from an e-currency and may not require a bank for payments. With this last component, a truly automated settlement that simply needs approvals at a few key steps could become a reality. So this illustrates that with an eSDR used in private transactions, that banks will no longer be needed in this environment of a popularized mainstream eSDR, and that payments without anyone's permission, without seeking the approval of a financial institution or third party, can be approved, facilitated, and settled peer-to-peer even within professional operations. And just to conclude here, it says with legal and technological reforms, crypto SDRs can provide a more stable foundation for global financial transactions and help to resolve the inherent defects of the current international financial system.
Well, Jesse?
Follow that, killer. All of these documents technically saying the same thing that the Rising Phoenix article said in 1988. So the Economist magazine had an article, it's the Rising Phoenix, and it said, get ready for a new world currency. A lot of people reference the Rising Phoenix, the actual cover of the magazine, where it shows that the fiat system was burning and you had this new global reserve currency, this new world currency that was rising from the ashes. A lot of people refer the cover of the magazine, but they often forget to really look at the article and see what did the article actually say about this new world reserve currency. And this is 1988. So in the article, they talk about how there's new technologies that are coming at the forefront and that would allow a new world currency to help with the FX market, global liquidity, and global trade. And it literally describes exactly what Ripple is doing to the T, my friend, to the T. Not a bit, not a lot. Everything is identical, literally, to what Ripple is doing. And in the article, they argued that the IMF, this is 1988, my friends, 1988. You're talking 22 years before the white paper for Bitcoin came out. And again, they're saying that they have new technologies that would make this possible. And the article argued that the IMF would be the best institution to manage, not only actually manage, but to create and manage this new currency, which describes exactly what Smoke has just showed us here, okay? And so this is 1988, and this is the year before technically David Schwartz gets the patent for Bitcoin. To me, it's the Bitcoin patent. He literally kind of admitted it recently. In 1988, if you Google Google search David Schwartz Bitcoin patent, okay, David Schwartz is the chief cryptographer for Ripple. If you Google search his name in Bitcoin patent, the first thing that comes up on Google is literally a patent for distributed computer systems that he was awarded in 1989 when he was working for the most powerful three-letter agency in the world. So just wanted people to take note here that everything Smoke is showing is, again, more evidence for the article that came out in 1988. And then we get the Bitcoin white paper in 2010 that doesn't line up at all with what we're seeing. Okay, the Bitcoin story does not make sense. We know that they had the technology before, but my point is that the article was really about, this new technology that they had, that they were going to be able to fix the Triffin's dilemma, like Smoke talked about, and to bring more a neutral bridge currency. So, because the issue with the Triffin's dilemma is when they agreed to the first Bretton Woods, okay, and keep in mind, guys, the IMF is calling for a new Bretton Woods. They're calling for a Bretton Woods 2.0. But the original Bretton Woods is when all the countries agreed that it's actually the same day the IMF was created, if I'm not mistaken. But the Bretton Woods Agreement was that all the nations would agree to hold US dollars and do global trade with the US dollar. And the US promised to hold gold in reserves for every dollar they issued. And then there was an economist named Triffin that said this is going to be problematic in the future because, as Smoke explained, the US, whichever country, if they would have chosen another country, it doesn't matter which country it is. If whoever country is serving as a global reserve currency is going to have to run deficits. And this causes a bunch of problems too, not only for that country, but for the other countries as well. Because let's say I'm China, just for example, and I'm forced, probably not the best example, but let's say I'm China and I'm forced to hold US dollars. Or better yet, let's look at some of the poorer countries, okay, undeveloped countries. Let's say I'm forced to hold the US dollar because I have to do global trade with the US. That's all that anybody accepts. It's the main global reserve currency to do global trade. Whatever policy the US makes affects me greatly, because if I'm holding US debt, let's say I'm holding US debt because I borrowed a bunch of money in US dollars to do my global trade, and then my dollar in my country starts weakening against the US dollar because they started doing monetary policy that strengthens the US dollar against my dollar, my sovereign currency, that's very problematic. Because now if my currency, if I'm holding US debt and my dollar is weakening against the US dollar, this debt becomes now 4, 5, 6, maybe 10, 20 times harder for me to pay. So you can't have a global reserve currency you can't have a sovereign currency serve as a global reserve currency. It just doesn't work. And I wish they had another way, aside from the IMF actually managing, just because of my personal opinion about that institution. But yeah, so that's what it's like. You said, it's all about fixing the Triffin's dilemma. It's about having a neutral bridge currency where every country can do whatever they want. They can hold whatever currencies they want. They want to, if does China want to hold Canadian dollars, or does Canada want to hold whatever currencies? They can do whatever they want, because once it comes to doing global trade and settling, they can just settle through this neutral bridge currency. Every central bank and country gets to do their own monetary policy and do whatever they want. And no country is affected by the monetary policies of one sovereign country, of, like, for example, the US in that case, right? The US can do whatever they want. It doesn't affect the other countries at all, because they can do all their own thing and hold whatever reserves they want to hold. So yeah, this goes back, and also to add on that, because he talked about private companies needing to be involved here in the new eSDR, because the reason for that is when they created the eSDR at the time, they didn't give it to private banks. They only gave it to certain banks. They didn't distribute it to everybody. They didn't distribute it to the tech companies. They didn't distribute it to private companies, to individuals. And so my understanding, based on my research, it did not get that global liquidity needed. It did not get enough use cases to get global liquidity, to have global liquidity. Because in order to serve as global liquidity, you need to inject it into every use case and into every aspect of society. When they created the SDR in 1969, they tried to do it without giving it to everybody, but that was the flaw. That was the mistake in the SDR, because they didn't distribute to everybody. They didn't put in the hands of the private companies, the tech companies, and say, hey, build use cases around this currency so that we have, so that it gains momentum, so it gains that liquidity. And so that's the issue. That's why it never got that global adoption. The original setup was flawed, as per my own research. And so yeah, that's what's happening, guys. That's why I say Ripple didn't start in 2020, my friends.
I certainly agree.
Hello everyone, this is Daniel, Max's robot AI assistant. Do these brothers a solid if you listen to the entire outline and type this keyword into the comments, and that is Triffin, as in Triffin's dilemma, and they will know that you listened to the entire outline. As Max would say, know what you have, know why you hold it. The research trumps FUD 110%. May the Lord Jesus bless you all. We will see you on the next one.
How would you like to earn an extra $100, $200, or even $500 a day, even more than that? I have many friends that are earning money every single day trading futures on BTCC. It's a simple process, and even if you don't want to learn how to trade, you could follow a trader on the site and let him do the trading for you, and you will earn according to his trades. Sometimes I follow All the Money by Q, and his trades earn me money. He has a 93% success rate, and he earns a great percentage. So even if you don't know how to trade, there is a way to make money. But I suggest learn how to trade. Earn you some extra money on BTCC. It's easy, you don't have to KYC, and you don't have to use a virtual private network VPN. This is a wonderful site. They've been around since 2011. Give them a shot. Also, when you earn that extra money, you can store that on your Decent wallet. The Decent wallet was not affected by the recent XRPL debacle, where the backdoor of many wallets was open and there was a breach. So Decent Wallet was not affected by that. Decent Wallet is as safe as you keep your seed phrase. It's a wonderful product, and you can get the discount by using the link. It's the only way to get the affiliate discount, and that is to use an affiliate link. So that link is popping up on the upper right side of your screen, and it is the one that you will use. You will also get free shipping. Pick you up a Decent Wallet today. Secure your assets. If you don't have them stored in a wallet and sitting on an exchange, then you're at risk. So pick you one up today. Thank you.